Welcome back to another episode of the Mike Smith Investment Show. In this episode, we're going to be going through the Gordon Growth Model, which is basically a way to value a stock based on their dividend. It's a lot easier than some of the other counterparts, such as a discounted cash flow model, and it works very well for mature companies with a very stable dividend. So I'm going to be using AbbVie, very reputable dividend stock, but you really want to make sure to pick out a company that has a lot of maturity and has a very stable dividend over a long period of time. So AbbVie does. I've outlined their current price. That's going to be important when we calculate the intrinsic value. This model has first the dividend per share for next period, which is expected, your required rate of return that you want to get out of the company depending on the risk, and then the growth rate or constant dividend growth rate. Now, if you can't find the dividend per share for next period, there's a quick and easy formula that I'll show, which basically takes the current dividend per share and multiplies it by 1 plus G. For most of this information, I'm just grabbing it from Seeking Alpha, which you guys can do so too, and I'll pop up kind of the estimates and where I found it. Alright, so the expected dividend per share for next year in 2026 is $6.86, so we'll add that to this box here, and the required rate of return that I want to get is, say, 10%. And now the growth rate over the past 5 years for AbbVie's dividend is around 7 to 6%. So we'll do 6.5%. Now we pretty much have it all figured out, but if you can't find the dividend per share for next period, which is pretty easy to, using Seeking Alpha, but if you can't, I'll run you through this formula super quickly. Okay, so to find that, find the dividend of the last period, which was 654 times 1 plus, and then the growth rate in F11. That gives us a dividend amount of 6.96, which is accurate to the dividend per share for next period. So once that is done, then we're going to actually construct the formula and find the intrinsic value. So we're going to do dividend per share for next period, divide that by R, the required rate of return, minus the growth rate. And that pops out our intrinsic value of 196. So if we have a required rate of return of 10%, then currently right now the current price would be overvalued. But if we change this number to say we want 8%, it's a very drastic change, but right now the stock price would be undervalued. So in some cases, I mean, there's certainly some pros and cons to this formula. From what this is saying, you would expect to at least get an 8% return. And if you're shooting for an 8% return right now, this stock price for AbbVie is undervalued. Say we change this to 9%, it would still then again be undervalued. And 9.4 seems right to be around the borderline for AbbVie in terms of their fair price and them currently being undervalued. So in terms of pros for this valuation method, it's definitely easy to use. It's very simple. Only a few variables that you actually have to put into the formula compared to a DCF that gets a lot more complicated. But you know, when you use this along with the DCF, you have a better idea of kind of figuring out where they sit in terms of their valuation. Another pro is that it's very good for stable companies, very mature companies that have offered a dividend that has been very stable over a long period of time. In terms of cons, it's unrealistic in terms of the growth assumption. I mean, it is basically deriving a constant dividend growth for a long period of time, which is just unrealistic due to, you know, business cycles and market changes. Although depending on how mature the company is, you know, even though they're in the bottom of the business cycle, they can still offer a very strong dividend. So it's important that you pick out a company that is extremely mature, that's been in the market for a long period of time, and that has consistently shown a very strong dividend. Although there are cases where, you know, we go into a recession and, you know, there's nothing you can really do about that. The other con is that you can only use this model for stocks that offer a dividend. You know, you use the expected dividend, you also use the dividend growth rate. So if a stock doesn't offer a dividend, you can't value it based on this model. Using this formula, I was able to create a couple of the best companies that I saw in terms of rate of return, their dividend last period, and these are all undervalued companies according to the model that I just showed. So we have AbbVie first up, very, very high dividend amount. Dividend last period was $6.56. The rate of return, while still being undervalued, was 9%. Then we have Amgen, rate of return was 12%, and the dividend last period was 9%. Definitely outlined this one as one of the best that I saw. PepsiCo, rate of return 10%, dividend last period $5.33. Lockheed Martin, rate of return 9%, dividend last period 12.75. That was another one that I saw. That, not to mention, you know, the defense space is really big right now with what's going on politically. And Merck & Co., rate of return 10%, dividend last period 3.12. So that's kind of the best ones that I saw, but definitely use this model. Find companies that are undervalued, take it with a grain of salt. It's not perfect, and there are problems with it, but use it to your advantage. Use ratios such as price to earnings ratio, other valuation models such as the discounted cash flow statement, and really create a strong stock analysis. Thank you for watching this episode. I hope you learned something new. Please make sure to subscribe. It does a lot for the channel, and comment down below on your opinion on this model. See you in the next episode.